Forget recession headlines. Wells Fargo's chief strategist says stocks will rally to new highs and critics will get burned. Is Wall Street ignoring real red flags?
We just had a actually really good earnings season when companies beat by 8% on EPS. It was actually the broadest beat that we saw in 4 years. 75% of companies beat on EPS.
So what would be, you made the earnings case, the bull side on the earnings side. What would be another bull case for why you think we're going to rally to 7,100?
Yeah, so we came up with 5 different reasons why. Earnings is one of them. The other one is seasonality, which typically gets more positive in November to December, especially for the laggards. So I think there could be a potential catch-up trade into year-end. Number 2, the IEEPA tariff refund, potential refund.
If the Supreme Court rules tariffs illegal, the government is going to have to pay back all the companies for the tariffs that they paid in.
I don't know if they'll actually pay back. I don't know if the checks are actually going to get issued, but I think they'll
reduce future tax obligations. Then it will go to the company's bottom lines.
Yeah, and I think what's going to happen is whether the checks actually get issued or not. What's going to happen is companies that raise prices already, they're going to keep their prices there.
Yeah,
their costs are just going to come down, so margins are going to improve. So I think there could be potential reflation trade into that potential event in January or so. Number 3, the tax return, that's going to be bigger because of One Big Beautiful Bill. We're talking about $800 more per person versus last year. Number 4, or actually lastly, the government reopening. I think
it will happen.
It will eventually.
I mean, we hope. We don't know when. But it's getting a little sketchy now at the airports. Congress is going to actually have to do its job at some point. Both parties just come together and do your damn job because that's why you're there and you work for us, not the other way around. Political rant over. But you think that is a good thing for the equity market? That's
what history suggests. And yeah, I think it's going to be an overhang removed for equities.
So those are pretty strong bull reasons why you're at 7,100 by the end of the year. Your job is to analyze risk in part. What would be, if you had to make it, what would be the bear case?
I think it's really the hyperscalers that's a little concerning because I think this AI capex cycle is still in the early innings. We think we're in the 4th inning of the AI capex cycle, so still in the earlier part. I suspect that this could continue for a little longer than what the market perceives right now. I almost think this is like maintenance capex that companies have to invest in AI to stay competitive. This is not necessarily growth capex to increase their growth rate, but to stay competitive. And if that's the case, their free cash flow is coming down. If you look at their free cash flow conversion versus earnings, it's going to go down to 50%. It used to be at 100%. Their free cash flow margin is going to be at an all-time low. So those are some of the concerning signs for the hyperscalers, which are the biggest companies in the S&P 500.
Can they alone, and that capital spending cycle, we kind of compared it the other day to when the United States built interstates from New York to LA or New York to San Francisco. They did that, and that sort of lifted almost the entire economy because the scale of investment was so big. Is that kind of what we're talking about here, Ohsung?
I think the multiplier effect of AI capex is smaller. So I don't think it's not as big of a tailwind as traditional capex. So we actually looked at how many jobs have actually been created from non-res construction versus how many jobs should have been created based on regression. And fewer jobs actually have been created, which means the AI capex cycle has created fewer jobs than what traditional capex would have.
Yeah.
So I think the multiplier effect is lower. And a lot of the layoffs that we saw yesterday from the Challenger data, about 20% of the layoffs were related to AI. So I think
But it also means that 80% weren't.
It's the economy. But the way I describe the AI economy is EPS up, layoffs up. It's great for the stock market. It's great for corporates. It's great for especially the big companies who have the access to capital to increase their productivity, but not so much for the real economy.